Welcome to the Tech Today podcast. It's your host, John Mayetta. So Nvidia, we have increased insider selling activity. I had a conversation about Gen AI with a friend of mine, an investor friend, over the weekend. And Nvidia came up, obviously. And, when thinking about valuation, Nvidia's had quite a run. It has grown into its valuation to a degree, but there's still a lot of momentum based into its valuation, in my view, right? My opinion. And so I'm sure there are others out there that share my view that NVIDIA is somewhat rich. So therefore, the risk is, if you are a large institutional holder and you're trying to figure out, do I trim my position? When do I trim it? Speaking of NVIDIA, you've got to be thinking about how many investors are out there that have a position that feel that NVIDIA may be rich and that could start selling in the near term. And that is a real risk. We saw NVIDIA get hit yesterday. When you look at the guidance the company put out and you figure it's a little bit conservative, but you had 23% sequential revenue growth in the most recently reported quarter. The company guided to 8% sequential growth for the soon to be reported quarter. So sequential growth is slowing, which is to be expected, given that you have easy comps versus last year. You can't continue to grow at 400% in perpetuity. In terms of the fundamentals, I feel that when you think about Gen AI, put AI aside, because AI, broadly speaking, has been around for many years. We've had companies that have deployed machine learning for over a decade. Machine learning and other permutations of AI, such as NLP, deep learning, neural networks. But when you think about ML, think about Netflix's movie recommendation engine, Amazon's Prime Video recommendations, Amazon's retail business, shopping recommendations, all of that is ML powered. AWS, Azure, GCP, the big cloud platforms have offered core AI services in their remote server business, their respective cloud businesses, for over a decade. So ML's been with us a long time. And has it created value? Sure. Will Gen AI deliver the same ROIC as machine learning? Well, that remains to be seen over the very long term. I would argue over the next year, 2 years, 3 years, it's going to be very difficult for Gen AI to justify the amount of capital that's been invested in the space. So in other words, I don't believe that Gen AI, and I hate to call it a space because it's really just if you think about artificial intelligence and ML and NLP and deep learning and neural networks and other permutations of artificial intelligence or advanced automation. Think of all those elements as arrows in a quiver. Gen AI is just another arrow in the quiver. So given the amount of capital that has been invested in that Gen AI quiver, I think it's going to be very difficult for Gen AI to earn a positive return on invested capital, or ROIC, over the next 2 or 3 years. I think it's going to be difficult to earn a positive ROIC over the next 5 years. I say this because the sums of money are enormous. And I'm talking about the entire value chain, from the chips to the large language models to the products and services. Many of those use cases have yet to be invented, frankly. I wrote, maybe I'll link to it in the show notes, I put a piece out several weeks ago about Microsoft Copilot, because that's probably the most high profile product, Gen AI product, that's been rolled out. Right? Microsoft's put a lot of capital into the product and a fair amount of money into marketing the offering, and that has not had a huge attach rate. It's one product I know, but I just feel like the amount of capital that both venture and companies are deploying in the space, it just feels like maybe the 1999 bubble, maybe '01 crypto, the crypto bubble, 99 being the dot-com bubble, of course. It feels like companies are throwing money after the space in the hopes to capture the valuation bump, not so much to because they believe in the substance. And so if you follow us at Tech Today or CEO Radar, you know that I'm a big believer in technology founder CEOs versus hired manager type of CEOs. And I believe that the founders just can anticipate better than the hired gun CEO. I believe that technology founders have more intellectual curiosity than do hired gun CEOs. So that's kind of a filter. I'm always going to have a bias toward a favorable bias toward technology founder CEOs. And then one of the other screens that I like in looking at companies is insider selling. And so look, Nvidia is what it is, quality management team, quality company. But if you look at purely the stock in terms of insider selling, and we put this little chart out yesterday, over the past 12 months, you've had 1 million shares purchased by insiders. You've had 7 million shares sold over the past 12 months. So sales activity as a percentage of that total is 87% over the past 12 months. If you look at the past 3 months, it's more intense on the sales side. So over the past 3 months, insiders purchased 29,000 shares. Over the past 3 months, insiders sold 5.2 million shares. So of the 5.3 million shares traded in the past 3 months by insiders, 99% of those transactions have been sales. So, you know, they probably know something. That's not to say that demand's going to fall off a cliff. I think you'll probably see a similar level of compute demand. So if you look at compute related revenue in the data center business, my guess would be that this quarter looks a lot like last quarter. I don't think demand falls off a cliff. Nvidia probably guided somewhat conservatively. So instead of 8% sequential revenue growth, they have, you know, some number that's modestly higher. But my guess would be that insiders know that the stock is priced for perfection. And that if Nvidia's report disappoints, you know, we're talking minutia, if there's just some element that's slightly off as a result versus someone's expectations, someone who was a top 10 holder, then maybe the stock trades off in pretty pronounced fashion because it is price perfection. When will demand roll over? That is tough to say. I feel, based on kind of what I've observed, I feel like a lot of companies at this juncture over the past couple of years, many companies have experimented with Gen AI. Many companies won't come back to Gen AI. You know, they've played with OpenAI's APIs, either through OpenAI or through Azure. Maybe they've played with Google Gemini's APIs. One of the things about AI in building models, whether it's a predictive analytic model or whatever the case may be, and I've talked about this before, written about this before, it's a difficult task. There are a few people that know data. There are a few people that know how to cleanse data, how to store data, how to label data for machine learning purposes, how labeling for training purposes. So if you're building a machine learning model, it's kind of critical that you not have bias in the data or any contaminants in the data, and that you label the data properly. As a result, only roughly 20% of AI, in quotes, broadly defined AI, only roughly 20% of those models make it to a production environment. I don't know what the number is for Gen AI. My guess, given the additional complexity and the fact that it's new, that percentage would be a lot less. Maybe 5% of all Gen AI models make it to production. So I feel that the end user demand is not there to support Gen AI valuations. Does that mean that Anthropic and OpenAI and Azure and AWS and Google will stop building LLMs? No. They will continue to build. They will continue to buy chips from Nvidia. Even Google, although they make their own TPU chip, they also buy Nvidia's chips. So I think the companies will continue to build LLM capability and capacity as they scale up the foundation. So we're still at the building stage, but I think that building stage could slow, and could slow soon, let's say in the next 6 months, if we don't start to see end user demand gain traction. That's all for now. See you next time.